Hello, folks. Dan Bird here on Friday, March the 15th. It is 10 minutes till 3 on the East Coast. I am leaving for Cabo, so I won't be around this weekend. So I promised Uber that I would do a couple of videos ahead of time. So even though the market's not closed yet, we'll take a look at it, see what's going on. For those that are subscribers, annual subscribers, I sent out an alert yesterday telling people what I've been seeing and pointing them to some of the charts that they could take a look at. I'll go over a little bit of that today. And then the second session today is going to be part 2 of my Technical Analysis 101 class that I gave a week ago, Monday. It's going to finish out that whole conversation. So let's jump into it for today. Share my screen. And we'll go to the homepage of my website. If you would like to get my newsletter, I'm going to try to get the newsletter out this week, but it might not be until Sunday because I'll be traveling most of the day Saturday, and I don't know what my internet connection is going to be like when I get to Cabo, but if possible, I will try to get out a quick newsletter at least. But just click on this button. That's where you can get it, or you can sign up to be reminded at the bottom of this page. Just sign up for the $0 newsletter notification if you want to be notified. All right, so this little ticker right here, I added to the website. You can see Nvidia is actually up. And I'm going to talk about, I should show that first today, because that's something I meant to do Wednesday and I forgot. AMD looks like it's up. Netflix is down. Oracle is down slightly. They had a great run though. SMCI down a little bit. So let's take a look right here on the main page. If we look at the S&P, notice that the S&P right now, again, we're about an hour and 10 minutes away from the close. So the S&P right now is sitting right on top of the 21-day moving average, which has been support all the way back to the beginning of this run in October. So if the uptrend is to continue, then that support needs to hold. We'll see if it does today. Now, the market has had a tendency the last 4 days, you can kind of see it here a little bit, that it would sell off and then recover in the afternoon and come back again. In fact, let me show you a 5-minute chart. We'll go back a couple of more days. This is 5 days, actually. So right here, this was a nice positive day here, but this is the 13th. So the market went down and then right at the very end came back up. This one here is yesterday, 14th. Market came down most of the day and right at the very end came back up. And right now we're down again, but is the same thing going to happen? Now we still have an hour, a little more than an hour left. So normally it's the last 30 minutes that the market, recovers and takes off a little bit. So we'll see what happens. I'll show this again before I end the session and also before I end the second session. But while we're here, let's look at Nvidia. And I had some questions about people asking if I got stopped out because I said that I was going to set a stop and the market was headed down and I might get stopped out this week, but I did not yet get stopped out. So this is what Nvidia looks like. You can see it's going sideways, which is actually a good thing. It would be actually a great thing if it just, because of this huge run that it had, if it just goes sideways for a while. In fact, if it goes sideways for a month, that would be really good because then we're starting about 3 weeks before earnings, and that's when it starts to take off again. So right now it looks pretty healthy. Here's a closer in view, and I'll show you why I set the stop where I did. If you notice this little gap right here, let me make this a little bit bigger. You notice this gap right in here. So this looks like March 1st, and then the next day it gapped up, March the 4th. And that gap has not yet closed. So what I did, especially since I'm going away and I don't want this to really drop dramatically. It could drop and just keep on going up. That's trading. That's what happens. But if we take a look at me draw a horizontal line right at that gap. You'll notice that it also touches the top of this resistance line right up here. Right there. Make this a little smaller. And move it up slightly. So it's right at the top. So it's both at the top of this before it had a pullback and right at the top of this one here on March 1st. So that's the open gap. That is at about 825. And that's where I set my stop. When I set it earlier this week, the 21-day moving average was at about 800. So it was below where my stop was. But I think I had mentioned that probably responding to somebody on the YouTube video that I was expecting the 21-day moving average to catch up to my stop. And right now it's at 827. So my stop is at 825 right now, a little bit below that 21-day moving average. Every day that goes by, if it just goes sideways, then the 21-day will continue to rise. Eventually, it will come up and meet price somewhere up there, probably in about 3 weeks. But right now, that is a really good stop, I think. So it's the open gap right here, and now is also the 21-day moving average. So that's kind of giving you some insight into the way I look at things, the way I look at charts, and how I use them to mitigate risk, basically. Everything else, you can see things are rolling over. Momentum is starting to come down. But it's outperforming the S&P and outperforming its peers, which is good. So we'll see. We'll see what happens. I'll be gone next week. Hopefully I'll still be able to watch it, but if not, my stop is set. If I get taken out, then I started out around 300. So 300 to 825, I would be very happy with that. All right, so that's Nvidia. Let's go back and take a look at the market. And in particular, some of the charts that I suggested that folks take a look at. So we'll go to the charts page right here. And you can look at the Santa rally. That'll be here for the rest of the year, basically. So you can always look at it. But this gives you a pretty clear picture that it's been riding the 21-day all the way from the bottom back here when the whole market took off. It's been coming back to the 21-day and then using that as support and then heading higher. We are almost there again. So will it use that again and continue to head higher? One of the things that I mentioned is this a buy the rumor, sell the news scenario? In other words, what I think, I've always said the market 6 to 9 months ahead of the economy. If the Fed is going to cut at some point, the market will be 6 months ahead of that. So it's starting to go up, and I think it's going up right now because it's expecting a cut. It may not know exactly when the cut's going to come, but it is expecting one, probably 6 months out. Now, when that cut does happen, does that mean all of this is priced in and the market will roll over and head down? It could. Depends on when that happens. If that cut comes in July or August, the further we push it out, then the more likely it's going to be during a very weak period, the August into beginning of November, which is the election. That is historically a very weak period anyway. So if the Fed does cut, there'll be lots of reasons for the market to roll over. But right now it's looking weak. It looks like it's running out of steam, basically, but that does not mean it can't keep going up. So we'll have to watch that 21-day moving average right there. Let's take a look at the VIX. That's one that I mentioned. The VIX right here. Bring this back in a little bit. So the VIX is continuing. Here's the S&P right here. VIX is continuing to go higher. It's making higher lows. So every time it comes back down, it doesn't come back down further than it did before. It's making a higher low and just made another one right here this week, actually. So the VIX is creeping up to that 17 number. If it gets over 17, then bears begin to control the narrative. And that's when the market will really start to accelerate to the downside. But right now, it's just, slowly chugging higher. And what I think the main reason for that is the algorithms. Algorithms don't care. they don't care what the charts look like. I mean, they care about the numbers, but they're basically looking at levels more than charts. So the algorithms or the computers are just looking at levels, and if it keeps making a higher high, then they will just keep buying. And the algorithms will continue to be in control until that changes. It's sort of like the commercial for what is it? Well, there's some commercial that says, it doesn't care. Shingles doesn't care. Shingles doesn't care what you're doing, doesn't care what you've got planned. Shingles doesn't care. Hopefully everybody has seen that commercial. Well, the markets and the algorithms and the computers are like that too. Computers don't care. They don't care, if these are rolling over. They don't care if there's a negative divergence. They don't care if the market has just continued to go higher week after week. They don't care. What they do care about is what level has it been hitting, and will it close below that level? If that happens, and that might be right below this 21-day moving average, then all the selling algorithms will kick in and it will start going down. All right, let's take a look at the McClellan oscillator. This is an oscillator that tracks advanced decline lines. And you can see as the market has just continued to go higher, it's doing so with fewer and fewer advancers. So that's not a good thing. And the bullish percent index also has a negative divergence. So lower bullishness with a higher market. It's like I said, it's running out of steam. But again, the algorithms don't care. Computers don't care until it breaks a particular level, which I think is probably right in here. So just below that 21-day moving average. But it will continue going higher until then. And it could continue higher for the next 3 months. Who knows? This is the National Association of Investment Managers. Interestingly, this had a negative divergence, and now investment managers are overly bullish. Whenever they get this extreme, in fact, it's almost to the extreme we had back here in July and August when we had that extended downtrend. It's nearly as high as it was in 2021. In fact, let me see if I can draw a line here, just out of curiosity. So there's where we are right here, almost right there. All right, so it's higher than it was. There was more bullishness right now than there was just before the big decline in July. More bullish than the decline in December into January. It is nearly as bullish as November, December of 21, just before we had that very long 2022 cyclical bear market. So that's why I drew the lines like this. If investment managers are extremely bullish, they normally are on the wrong side of the market. So they are at an extreme right now. And you can see the green line, this is the time to buy, is when investment managers are overly bearish, when they all think the market can't do anything but go down. You can see that happen right here just before the bottom, about 2 weeks before the bottom. These are weekly charts. So they were extremely bearish. That's the time to start buying. So keep an eye on that. That's on the website over in the sentiment area under an AAIM bull and bear chart. We can also take a look at the Keltner channels, which shows you extremes. So you can see we were at an extreme right here. It's pulled back now again to that 21-day. That's the retracement to the mean right there. Just pull back almost to the 21-day. That's the place where it's bounced in the past. That's what the algorithms are going to look at. If it doesn't, if it drops through that and closes below it, I expect to see a lot more selling. But it hasn't happened yet. So don't anticipate things like that. Wait and see what happens. By the way, I just added the S&P large cap, mid cap, and small cap, the top 10 in each of those categories onto the website. If people are just interested, I'll keep that updated every week as well. PPI came out yesterday, PPI was higher, quite a bit higher, actually, which is what I said on Wednesday. It probably would end up being higher for a number of reasons, but PPI looks like it's starting to move back up. So will that affect what the Fed does next week? They probably will talk tough on inflation. I don't know if they will actually raise, but they could. But at least they probably will be talking tough. So PPI went up. CPI headline also went up. So you can see the went up from 3.1 to 3.2. Forecast was 3.1. So it was higher than the previous month and higher than forecast. So all of those things indicate that inflation may be making a comeback. One way to also look at this, and I do this before every CPI number, is the Fed rate hikes. And on this chart right here, you can see this grayed area is the month that will be reported on next month. So the one we just finished was for, so we got the report, actually it was this month that we just finished. We got the report in March, it was for this grayed out area. And you can see food dramatically higher, CRB, which are these commodities here, dramatically higher. Gasoline and oil also continued higher. But look what's happened so far this month. I've got to move this out of the way because it's going up so quickly. So food dramatically higher. Gasoline and oil are also creeping higher. If these continue, if we finish the month, and actually next month, this will cover this section right here. So the next CPI report will be for this shaded section right here. So we've got another half a month left to go. If this continues to go up even higher than it is now, then I expect a very bad CPI number next month. And part of the reason for that is, if you'll notice, the one that drops off in April is a very small one. So when small ones drop off, that causes CPI to go higher very rapidly. When big ones drop off, it should help CPI come down. Now, it didn't this month. And that's because of the commodities. That's the reason right there. So commodities, and especially food, is going up even more steeply. The Fed's watching this too. So again, I would not be surprised if they raise a quarter point next week. Don't know that they will, but wouldn't surprise me if they did. All right. So where are we now? By the way, one of the things that I mentioned in my alert was I update these industry groups every day. And this is the most I have ever seen with down arrows. There is not one green up arrow in any of these industries. This is the end of the day yesterday. I'll do this again the end of the day today. I don't know which ones will come out, but these are the most down arrows I've ever seen. And every single sector has an industry group that lost. There were no green up arrows. Every single sector except for energy had down arrows. There's energy just taking off. So energy's been on a tear ever since the middle of February, really since January, middle of January, then it went sideways. But energy looks like the place to be, and that's the place where big traders might park their money. They think that the market might be heading lower. You can also see here with the XLY, XLP. So this is discretionary versus staples. It is heading lower, which means there's rotation out of discretionary and into staples. These are the weightings. So in discretionary, Amazon and Tesla make up 42% of that ETF. And this is the XLP, which are the staples. Staples are conservative. Discretionary is more aggressive. And you can see a little bit the same with the equal weighted. I mean, this shows how heavily weighted these particular names are. But even the equal weighted is starting to roll over as well. So that's not good news. And if we look at growth versus value, it's actually hanging in there, okay, but it's heading down. But it hasn't really broken this uptrend line yet. So we want to continue to watch that. This is the Russell 2000. Russell 2000 actually it had been doing really well, and then the last week or so, it just sort of rolled over. You can see the small cap down here, the green one. It was outpacing the velocity of that line was steeper than large and mid caps, but now it's actually rolled over and starting to head down along with the rest of them. So all of those things indicate that there's rotation going on. It looks like out of aggressive sectors and into conservative, safe sectors. So it's something that we want to keep an eye on. That's one more thing. I'm going to show you VectorVest. So here's VectorVest. And I'll show you why I'm showing this in a second. So this is today. Remember, the market's not closed yet. It's got a red and two yellows. Actually, the BSR was red also. In order for this to give a confirmed down signal, we have to have 2 weeks, and let me show you this on a graph. We need to have 2 consecutive weeks lower. And let's look at this way. So this is where we are right now, Friday. So 1, 2, 3, 4, 5. So this week we are definitely lower than a week ago. And if we go back another week, 1, 2, 3, 4, 5, right here, we are also lower than 2 weeks ago. So that's the first criteria. If we end lower today, and again, it's 310 right now, and the market is still looks pretty red. I'll show you the daily chart in a second. But if we end lower today, then the first criteria is satisfied for a confirmed down from VectorVest. The second criteria, so it has to be down 2 weeks in a row. So if we end today lower, like we are right now, in fact, we need to be closing price is 65.42. And right now we're at 65.17. So we have to be above 65.42 in order not for this criteria to be met. The second criteria is the BSR has to be below 1, which it already is. BSR is the buy-sell ratio, the number of buys versus the number of sells. If it's below 1, that means there are more sells than there are buys. So if that stays below 1, the end of today and into Monday, and we stay below the 2-week point from 2 weeks ago, then Monday will most likely, we will get a confirmed down signal. Now, why is that important as far as what we're doing? So on the portfolios page, I've talked about this market timing strategy. It's as of yesterday was up actually on the 13th. On the 14th, it was up 100 and almost 110%. 13th was the anniversary date. 110%, that's coming down a little bit. We'll see what happens today. If we look at the long-term chart, it's definitely coming down. There's a support line right there at about 80. And if we look at the shorter term daily chart, you can see 2 red bars right now, and we're getting close to that 50-day. We're right on the previous support lines right now. So if that breaks down, then all of these indicators will also be heading lower. However, I don't go by just simply what these charts look like. I am going to also use the VectorVest confirmed down signal as the signal to go to cash. So if we get a confirmed down on Monday, and one reason I'm saying this is because I'm going to be in Cabo on Monday, so I'm not going to be able to report on it. But if we do get another down day on Monday, then we probably will get a confirmed down on VectorVest. And this will then have a blue line like it did right here. This is the entry point. This will then have a blue line that says move to cash. So that's the thing to watch on the website. To just watch these charts and see if they get a blue line, which is move to cash. It doesn't mean to go short and take an aggressive short position. That just means move to the side and let's see what the market wants to do. Will it keep going down or will it reverse and go back up? I don't want to trust it. So I'd like to take our 110%, or this might be 104% by the end of today, I'd rather take our double and put it in the books. All right, so that's it for today. Hopefully that gave everyone an idea. Let's go back and look at the S&P. Let me see if I can find the daily. All right, let's use this one. So here's the daily so far. Right now it is basically 315. So it does look like we're starting to rally a little bit here at the end of the day, but we'll see if that continues into 4 o'clock. So my next session, I'm going to do part 2 of technical analysis 101, and we'll look at this again before the close of the market. All right, thanks everyone. Thanks for listening. Hope you have a great week, and be cautious. Take care.